Hey.
Hey everyone, Ryan Bolton here with RyanBolton.com, local mortgage expert, back at it again, answering questions on Quora that are related to mortgage and real estate. And I haven't looked at any of the questions. I'm just going to open up Quora and just see what questions are there and just have a little bit of fun with this. So if you have any comments, questions, posts, anything you want me to take a look at, I'd love to do a whole video that's just on like viewer questions and things like that. So please like, subscribe, and put a comment in so we can answer your questions. All right, let's just jump right into this sucker. Wrong screen. All right, here we go. Okay, if a real estate agent has two buyers interested in the same house, can the agent show the house to both buyers? Yes. There is no conflict of interest. There's no problem with being able to show both buyers. Now, if one of them's putting it under contract and they know about it, it gets a little sticky because they're supposed to represent both. But if both buyers are interested in the same house, they don't have any kind of qualm with showing it to both of them. Now, when it gets time to, it can be definitely awkward, but there's not anything against the law or anything against the contracts that says that they can't show the same house to separate clients or multiple clients. So that's a pretty good question there. But yeah, the short answer is no. The agent can show the house to every single one. Now, if it's under contract with the buyer, they're not supposed to be able to tell the terms or what's going on with the house or if it's going to fall through or anything like that. So they are supposed to keep it separate when it's actually under contract. But as far as showing the house, no, they can show the house to multiple clients if they want to. And then once it goes under contract, different things kick in. Is it better to buy a house with family or friends? Why or why not? Boy, that really depends. Anybody that's gone into business with a family member or a closer friend, there's always more tension, backstory, issues. There's really a difference in our lives, whether it's personal or business. When those things kind of butt heads, usually relationships go south, unfortunately, whether it's business or buying a home or anything like that. Now, one of the benefits of buying a home from a family member is they can gift you some of the equity. So you can set the purchase price, say at the appraised value, and they only need to net a certain amount to kind of get out of it, and they want to help you out. They can actually gift the difference as long as it's built into the sales price and built into the contract. So it's not like you can sell the house, let's just say at $200,000, but it's worth $250 and do the loan at $250. You'd actually want to set the sales price at $250 and then gift the difference. So then you don't have to come up with the down payment or closing costs or things like that. So there is some benefits of buying and selling with family members if you structure the deal right. But most people just don't know how to do that. So that's where they either have to call a real estate agent or even better still, call a lender that can show you how to kind of structure that. Now, a lender cannot negotiate on your behalf. They can't go in and say, okay, your son wants to offer you this, or, the dad wants to buy this. You can't do that negotiation. That's what a real estate agent's supposed to do. But you can at least tell them, okay, this is how you can structure. They can review the contract for you and just kind of show you how that would work. But I've seen a lot of times where a family member just wants to sell the house for a certain amount, even though it's worth more. Maybe it needs repairs, or they just want to help a family member out and not have to deal with putting it on the market and all that stuff. So the best thing to do there is set the sales price as high as you can and then get more for it, whether that's more down payment, more gift fund, whatever. That's usually the better way to go, which can be a little counterintuitive. Most people say, no, well, I want the contract to be as low as possible. Well, like I said, if you only need $200,000 of gift to mom and dad, but it's worth $250, but you do the contract at $200,000, you have to put your down payment on the $200,000, even though it's got all that equity. So structure the contract correctly can make a big difference when you're buying from a family member. So again, on Quora, they just have all these different questions. Usually they categorize it, whether it's based in certain categories, but every once in a while questions just pop up in the real estate feed for no reason. But should I get myself checked? Should I get myself checked? Yeah, absolutely. Yeah, if you're leaking oil, it's probably time to get checked. All right, what else we got here? Let's see, how can you put your bills towards your credit? So this is a kind of a new thing the credit bureaus are doing. Boost is what I think Experian calls it, where you can take bills that are not normally reported to credit, like utility bills, cell phone, rental, any insurances, things that you are paying on time on a regular basis, but aren't necessarily a debt or a line of credit or something that reports to credit bureaus. So this is becoming a lot more popular to be able to build a credit file when you don't have those traditional lines of credit or traditional auto loans or things like that, but you are making a regular payment. The most common things are like car insurance. I've seen that, or utility bills or cell phone bills. You've had an account with Verizon or T-Mobile or whatever it is, and you've had it for 12 months. You can actually show you've made those payments, get it reported to credit, and help boost your credit score. One of the best ways to boost your credit score, however, is a revolving line of credit. So this is anything that's a gas card, an overdraft, or something where you can use it, pay it off, use it, pay it off. The trick is get the credit card or whatever it is and put a small balance on it, maybe $50. So it's under 30% of its limit, and just do it that way. Now, I have people tell me all the time that they use their credit card, pay it, use it, pay it, use it. The problem is the credit bureaus only see it once a month. So if you have a maxed out card or it's over that 30% of the limit, that's what they'll report. They don't re-report till the next month. So if you paid it off that very second, it doesn't report till the next month. And if you've slowly used it again, it's back up to $500 or $1,000 or whatever it is, they only see it at that amount. So the trick is not to use it, pay it off, use it. It's better to actually maintain just a small 20% of the limit, 10% of the limit, just some sort of small balance on it will actually help your score more. But adding other bills can help your credit as well. Is a mortgage cheaper than renting? It depends on the area you're at, but generally no. A mortgage payment is going to be more than the equivalent house for renting that same home. But there's more benefits with it as far as appreciation. You have more benefits of locking in that payment. So yeah, maybe the payment's more, but ask yourself, on the last couple times you've rented, has the rent gone down? Has it gone up? Does it go up every renewal? Has it gone up a lot in the last 2 years? So even though the mortgage payment might be higher right now, you get way more benefit from it, and you're locking it in far longer than you are any kind of rental payment. So generally speaking, yes, mortgages are going to be more, but you get way more for it. And I tell people all the time, if you're renting, you do have a mortgage. It's just somebody else's. They're getting the tax benefits. They're getting the appreciation, all that. Now, everybody needs to rent. I'm not trying to completely downplay how rental, and they are a little bit cheaper, and you're just starting out, and you're starting a job and your career and your marriage and your kids, all that kind of stuff. I totally get it. But if you can qualify for a house, get the house. Get the house. I'm a little biased, but get the house. I've got a bunch of rental properties. I've never gone wrong with real estate. I went through the 08 crisis as well. Sure, equity dropped. All kinds of problems happened with it, but all of it recovered and then some in the time frame. So short term, yeah, there might be some things that pop up here and there, and timing might be crucial. But long term, real estate's where it's at, baby. Real estate's where it's at. All right, what else we got? Zero down payment mortgage sounds too good to be true. Is it? Depends. It really does depend. But I would say this. The amount of money you can put down on a home, say $50,000, doesn't lower your payment versus taking that same $50,000 and reinvesting in other places, paying off other debts. So the downside with 100% is usually the rates are going to be a little bit higher. The mortgage insurance might be a little bit higher. There is some things that factor in to offset the risk of loaning 100%. But it is something where if you can get the money and you can qualify for those types of programs and just do the math on it to say, okay, well, I can put $50,000 down and save $50 a month, or I can take 50 grand and pay off all the cars, pay off all the debts, pay off everything else, and have a lower monthly payment every month while still being able to maintain lifestyle and all those things. So I'm a big believer in putting down as low as you can to make all the numbers work, because it just frees up that capital for other things, which then you don't need maybe a car loan in the future, or you don't need to borrow money if an emergency happens or the car does break down or repairs on the home need. There's so many ways. There's so many better reasons to have money in the bank than a bunch of equity in the home, especially when it doesn't really change the payment that much. Even at a 6 or 7% interest rate, you're still better off to have it in a mortgage than any other type of debt. So I think it's well worth at least running the numbers and really just compare. Say, well, my payment is this with 20% down. My payment is this with no money down or 5% down. See what the difference is. You'll be surprised how much money you're tying up without really saving that much per month. So it's worth running the numbers. All right, what else we got here? Is buying a condo for rental purposes a good investment? Yes, it can be. Depends on the cash flow. Depends on what they rent for. Keep in mind, though, a lot of condominium projects will have restrictions of how many units can be rentals, because if an entire HOA or an entire housing project is all rentals, it becomes harder to get lending in those areas. So it is something where it can be good, but if you get to the point where you can't sell it to another investor, then your market share of who you can sell it to also goes downhill a little bit. So just like anything, you've got to do your due diligence on it. You got to find out how many other rentals are in the condominium project. You also have to find out if they have restrictions on if they can be rented. Financing, you have to put a little more money down typically on that type of home. Rates are going to be a little bit higher. So it does it make sense? Sure. It depends. Depends on if your payment's $4,000 a month and you can only rent it for $2,000. No, it's not a good investment. But generally speaking, I think more times than not, investing in real estate is always going to be a good move. It just may be a little more of a long-term play in some markets. Let's see. What does a real estate analyst do? They analyze real estate. Yeah, that's what they do. Here's a longer question. Okay. Could the Fed raising rates very fast cause people to default on their mortgage and raise rates to levels not seen since 2008 and they struggle to pay their mortgage? Sure, but here's the thing. So if the Fed raises the rate, but you've locked in your interest rate on your mortgage last year, just because the Fed raised rates doesn't mean that your mortgage is now going up because you're locked in. That's the difference between renting and owning. Your payment's locked in. Your taxes and insurance might adjust a little bit on the home, but they're very small changes usually on those types of things, where rental increases are been huge. I think in the last year, rents have gone up like crazy because home prices have gone up and debt servicing those houses has gone up and everything's gone up, but rents have gone up a lot more than any mortgage payments. So I don't see somebody that's all of a sudden going to default on their loan because the Fed raised the interest rates. If anything, they're more secured against rates going up because they've already bought their home. So they don't have to worry about if rates change. So I don't see people all of a sudden struggling to make their mortgage payment. But with Fed raising the rates, maybe that affects job markets. That could affect other things that will start to have maybe defaults increase. But the idea of the Fed raising the rate is to help to stabilize things so it doesn't become crashes. Is the whole idea of them raising rates to kind of keep an eye on the market, just because there's so much money just floating out there that they just got to raise the rates to be able to control that. So it is something where I don't see just because rates are going up that all of a sudden defaults are going to go up, because most people locked in their rate. So their housing payment's cheaper on the house they're in than if they lose the house and go somewhere else. I don't see defaults really going up like crazy, because most people have more equity in the home because they either put more money down or they have an incredible interest rate or their housing payments lower on the home they're in than what it would take to replace it. So they're going to work with trying to keep the home more now than they did in 08. 08, everybody was upside down. Rates were going down, but they couldn't refinance because they were upside down on the home. So they just walked away. So defaults went up because of lending practices way more than what the Fed will do with rates or with what's happening in the market now. More people have equity. 08, equity was gone and rates were dropping, but people couldn't refi because they were upside down. So then underwater programs started coming out to just try to help people stay in the home and take advantage of the lower interest rates, so that it was better for them to stay in the home than just walk away. I think the same thing happens this time. There's more benefit to stay in the home than walking away because there is still more equity. Even if the prices of the homes drop a little bit, they're still going to have more equity than if they sell, or their payment's going to be lower if they sell. So I don't see the same 08 crisis happen. Now, maybe something else will happen. There'll be other things that might happen. Sure, but it's not anywhere near what we saw in 08. All right, what else we got? How are we doing on time? I try to keep these relatively short. Okay. Let's see. When buying your first home, what are the most important things to consider besides the price? Location. That's one of the biggest things on real estate. Location, 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 for a reason. It'll be easier to resell. It'll be easier to get to your job. It'll be all those things more comfortable. I mean, location is probably the next thing other than price. The other thing I would say is look at your needs versus wants. Too many times people will muddy those waters a little bit. And sometimes you can sacrifice the want a little bit because you can add it later, or when you upgrade, when you have kids. I mean, you're not keeping the home for 30 years. I hear that all the time. I don't want to have a loan for 30. You're not going to have 30 years. Most people stay in their home between 7 to 10 years because either job changes, or you outgrow the home, or you build up a bunch of equity and you can sell it and build a brand new house. So they are longer term than other purchases like cars and other things like that, but they're not long, like crazy 30-year term. It's very rare that people keep in their house for 30 years, pass it down to their kids, all that kind of stuff. That's very, very rare. So it is something where outside of price, location is important, and knowing what your needs are versus your wants. If you've got to have that garage, if you've got to have a certain bedroom count, if you've got to have a fenced yard, you've got to be in this part of town. I mean, those are the things you want to look at besides price. All right, let's see. Let's do, what are we at? Let's sneak one more in here, and we'll call it another day. All right. Okay. When you can buy a home for around $100,000 and pay for a mortgage around $1,300, why do people rent around $1,500 a month instead of buying the house? Great question. I fumbled through that pretty much, but basically it's asking, okay, if you can get a mortgage at 13, why would you rent at 15? I don't know. There's maybe a lot of factors. Maybe the credit score, maybe they've gone through a divorce or bankruptcy or something where they just can't buy a home. There might be legal reasons, credit reasons, job qualifications, no down payment. There's 100% financing options out there, but I would say it's pretty rare right now where the mortgage is less than the house. So sometimes a $1,500 rent goes further than a $1,300 mortgage payment. So I would say that's probably a bigger factor there, that you can just get maybe a little more home to rent it, but you're not locking in your payment. You're not getting the tax benefits. You're not getting the appreciation, just like we've been talking about. It's still going to be better to try to buy that house. But I would say, to answer that question, that it's something where maybe the $1,500 home rental gives them a little more home, square footage, location, bigger house than the same $1,300 mortgage because of just what it takes to qualify. It might be debt ratio. Maybe they are self-employed. They write too much off. They don't make any income on paper. Maybe there's a lot of reasons why people don't even try to get a mortgage. But I think more people should at least try, at least start down that road and start earlier. Here's a tip for you. If your lease is going to expire, you know it's going to expire in 90 days, start working on something else. Don't wait till the last second. I can't believe how many people will wait till 2 weeks out, 1 week out. I don't know. It's our society that's such a microwave society. Now, put out, just go from fire to fire, paycheck to paycheck. I mean, it's just kind of how our society is. Give yourself some more time, people. I can't tell you how many times, if we would have had 30 days, if we would have started just a little sooner, we could have worked on maybe some credit issues or worked on some savings or paid off something or just saved us so many hassles, or created this artificial deadline like, I've got to be out of the rental on this day or I'm going to be homeless. Why would you put yourself in that situation? Start earlier. Start 60 days out. Get your ducks in a row. So maybe even you move into the house before your lease expires. So you got time to take a weekend to move and clean up the thing. I can't believe the stress that people have to be out of a house and into a next one, renting 2 trucks, renting a storage unit, all because of not giving yourself a little bit more time. Just start earlier. Don't wait till the last second. That is probably the best tip I can give you to save on this stressful situation, is have more than enough time, not enough time, because you also will limit your options when you don't have enough time, whether that is buying a house or moving into another rental. Give yourself a little more time. Will save you so much. 2 weeks can be such a difference on these types of deals. So if you need help with a home loan, I'm here in Utah. I'm in southern Utah, St. George, Utah. I lend throughout the whole state of Utah and all of Nevada. If you need any help, check out my website at ryanbolton.com, BOLTON. It's down the bottom of the video here. But I'd love an opportunity to help you if you're looking for a loan in those states. But if you have any questions, I can answer. I love doing this. Whether you're in those states or need a loan or not, call me. You can go to my website. There's a little scheduler there. You can schedule a call or a meeting in my office, and we can talk about anything you need when it comes to real estate financing. If you're a real estate investor, you want to start buying and renting homes, I can give you great tips on that. Love to help you. So call me anytime. Hope you enjoyed the show. Please like and comment if there's anything you would like to have answered or any comments or questions that you have. I'd love to do a viewer video as well. So call me, comment, or check out my website at ryanbolton.com. So appreciate your time. Hope you enjoyed the show, and see you next time.